Inflation coming in hotter than expected. Many people now suggesting rates are going to be higher for longer. In fact, Jamie Dimon, CEO of JP Morgan, put in his most recent shareholders meeting that, yes, we anticipate rates being higher for longer. So what does all this mean for commercial real estate financing? We're talking about that and more today here on the Commercial Real Estate Report, empowering you to build generational wealth with commercial real estate. I'm your host, Chris Berg, head of business development with Abernathy Holdings. We go out and build Class A self-storage sites. As of today in California and Arizona, soon to be beyond, and excited to share with you. Very special guest today, good friend of mine, 12 years in commercial real estate financing. He's now the senior director at Walker Dunlop, very well versed in Fannie Mae and Freddie Mac programs. Recently, I want to share this with you, 2024 Globe Street Rainmaker in commercial real estate. Love rainmakers. Also 2024 Los Angeles Times Visionary in real estate finance, the one and only Chris Montes. Chris, welcome to the show. It's great to have you, my friend.
Thanks for having me, Chris. Glad to be here.
I got to ask you this. So what exactly does it mean? How do you win an award to be a visionary in real estate finance?
That's a good question. Well, look, the LA Times reached out to Walker and Dunlop about me and some of the stuff that I've done in the multifamily space. I think that award is largely because of creativity around affordable housing, workforce housing, and social impact investing across the country. So, I tend to focus on that and have a lot of clients that's very important to, and it's very important to me. So, I think that's why I was given that award, quite honestly.
So then walk us through some of the creative financing you've been doing. I was recently at the ISS Big Self-Storage Expo in Vegas, and some people I were talking to were saying the same thing. People right now, bridge loans and perm and things like that, just trying to get creative to make things work.
Yeah, it's a good question, Chris. I would say, some of the stuff that we've done recently for clients has been different capital stack structures. So traditionally, let's say you had a construction loan if you're trying to build something, right? Cost of construction debt today varies on product type, market, leverage, all the different levers. But let's just say, for making up a number, if you're at 65% leverage on a construction loan, maybe that costs you 10.5% today. Let's just ballpark it. Multifamily, I'm talking about. We've gotten creative with that capital stack by bringing other components in there. So not just a traditional construction lender, but also call it a C-PACE lender or private money. It might just be a high net worth individual that's looking to get a yield on their money. So just in those different methods of putting a capital stack together, we've been able to save clients, call it 2 or 3% carrying cost on those construction projects, which is material when you start. If you have a project that, has a budget of $25 million and you're borrowing, call it, $16-17 million over 3 years, 2 years, it's real money. So that's an example of one. The other, maintain liquidity today is of high importance to a lot of people, right? They want to remain liquid. They want to remain opportunistic. Traditionally with construction debt, as a principal, you would contribute your equity to that project and then start drawing down on construction dollars. We've structured construction loans and capital stacks where the initial equity contribution isn't necessarily all coming from the principal, but it's rather structured in what's called a pari passu funding structure, which I think might be Latin or Greek. I'm not sure, but
it's
I know. I'll explain it to you. It's essentially like if you have, let's say, a $15 million construction loan, and you're supposed to contribute $7 million of your equity before you draw down. Rather than doing it that way, which is the traditional way, a pari passu structure is negotiated. So this is a generality, but let's say that we structured for yourself, for Abernathy Holdings, or for a client of mine, every dollar you put in, the construction lender would put in $1. So you're splitting the equity contribution out the gate with a construction lender, which at the end of the day, what's the benefit of that is you maintain your liquidity a little bit longer, right? You're still deploying your liquidity. You're still deploying your $7 million, but it's not, call it in the first 9 months or 6 months of your development cycle. It's stretched out over 2 years. So you're able to maintain some liquidity, and that's important to clients today.
I was going to say, so what does the client need to have for a bank to agree to that? Because I'm also hearing from a lot of clients, people that have done billions of dollars with some banks, and the banks are going, hey, we can do that loan, but then we need, 30% of your deposits or a big deposit from you. And so you can tell that banks are just say a little bit more reserved, no pun intended. So in order to do this French dessert that you just mentioned, the tiramisu,
I like the pun. I like the intended pun there, Chris. The reserves. I mean, look, with banks, they're always going to look for reserves. I didn't mean to cut you off. Go for it.
But so, yeah, I mean, what do they want to have a long-term relationship with that particular client? What do they need to see to feel comfortable doing that with that client?
Yeah, it depends. The lenders that we've done that pari passu funding structure with actually haven't been banks. And most of the construction debt that we've done recently has not been with banks. Not trying to call out the banks or talk bad about the banks, but to your point, that reserve number, right? If they're lending you 50 or 55% loan to cost, and then they're asking for 10% or 20% of deposit, what's your true leverage look like on that opportunity, right? It's, for some people, maybe it's okay. For most people, it's not attractive. So these lenders that we've been working with are alternative capital to local banks. So debt funds, high net worth individuals, a variety of other sources. So there are no reserve requirements that they have.
I love what you do. I mean, you and I have spent some time together, so I have a somewhat of an idea, but now to hear you speak to it more in depth, I can see, and I want to kind of go through your process, because what I'm hearing you say is, hey, Chris, I get some information from a particular client, and then it becomes this big different pieces of a puzzle. And then it's sort of your job to go, okay, I can put this one here and this one here to make this full picture that you can then present to that lender. Is that, number one, a fair assessment? And if that is, walk me through your process. How do you go about putting these pieces of the puzzle together to make things happen?
Yeah, it's a good question, Chris. I would say it's all client specific, right? Like, client knows their business better than I do, right? As much as I want to learn about their business and as much as I'm, familiar with their business, they know it better than I, right? So from client to client, the objectives and priorities are going to be a little bit different, but generally they're kind of the same. They want the best cost capital. They want, maybe the highest leverage. They want to be able to close quickly, and they want good execution. It's kind of, what everyone wants, right? So the generalization. I would say that, to answer your question, though, a client will present an opportunity, tell us their objectives. We'll do our best to ascertain what those objectives are and memorialize that into, call it a marketing pitch or a marketing book or an offering memorandum. We'll go out to different lender relationships that we have, that we've transacted with in the past, and we'll sell what they're doing, right? We'll talk to our experience with them. We'll talk to their reputation in the market. We'll talk to the project, and line up a variety of capital sources. And at the end of the day, we'll present a dozen options to a client, and they they'll have questions for us. Some questions we'll know the answers to. Some we'll have to come back to and talk to the lender in more detail. At the end of the day, it usually comes down to 2 or 3 forces, and then they ultimately make the final decision. We're sort of off to the races at that point.
So let's go through a simple theoretical example. We've got a project up in Fresno. We want to break ground probably end of Q3, early Q4. I know that we're going to actually put some numbers in front of you to see what you can do. So let's say we put that budget in front of you, and just for easy numbers, let's say it's $20 million. What's the process with you?
Yeah, it's a good question. So typically the process would be share the information, let us get an understanding of the opportunity, and let us make a couple of phone calls and put some feelers out there and see kind of how the market receives the opportunity, what kind of intel we're getting, and whether or not we can achieve the objective that you have, right? So at a high level, if we can, before we exhaust you guys or exhaust a client or, put too much, time into the opportunity, just kind of give it a little sniff test to make sure that we can actually achieve your objectives. If we can, and we feel like there's good certainty, then at that point, we'll start to dig in, and, you and I would go back and forth with a series of questions and information requests for a week or two. And then we'd go out and officially market the opportunity with, 200 plus lenders that we have relationships with that rely on myself, Walker Dunlop, to bring them opportunities. Some of these lenders, they don't have a mortgage origination staff, so they don't have a banker. They rely on what's called a correspondent agreement. So Walker Dunlop would be a correspondent for some of these lenders, and we're a funnel for opportunities for them. So, and some do have bankers. It just, me being a banker myself and being a numbers guy, I could do a pretty quick analysis to figure out whether or not something is feasible or not. and I could talk to, just the desirability of the project and the opportunity and the upside. So, I mean, that's operating as a mortgage broker. We are also a direct lender. So we do Fannie, Freddie, and HUD lending directly. So there's no intermediary there. And that's actually the core of my background is agency financing.
Yeah, I want to get into the affordable housing piece in a little bit. One of the things I forgot to mention in the intro, you also got a nice sized portfolio of affordable housing that you're doing. So we'll have that conversation in a moment. But I started today talking about the hotter than expected inflation numbers. Many people now suggesting we're going to see the Fed rate higher for longer. One, how do you interpret the data from today? What do you think that means for the Federal Reserve? And what are you hearing out there in the marketplace right now?
Yeah, I think what I'm hearing is consistent with what you just said, Chris, higher for longer. The question is how long, right? Is it 6 months? Is it through the end of the year? Is it 5 years? Is it forever, right? Like that's really the question. My interpretation of the CPI data that came out today, CPI came back a little bit higher, right? I think we're at 3.5 at the end of March. Over the past 12 months, on average, we're at 3.8, which is obviously higher than the expectation that the Fed has. Some of that, when you look at that CPI data and everything that goes into it, there's different components of it. Some of it is housing, some of it is the cost of rentals, some of it is the cost of single family. About 26% of that CPI data is tied to the real estate market, 10% of it to market rents, 16% of it to single family homes and what owners believe that they could rent out their home for. And so it's sort of interesting that you have, call it 25% of that CPI is tied to the real estate market, 10% of that to rents that are being reported. And this is all from the Bureau of Labor Statistics. So it's sort of there's a lagging indication, right? Like if you talk to any multifamily owner operator today, they're not seeing rents increase, today. They're flat, maybe negative. But the data that's being reported by the Fed and by the Bureau of Labor Statistics is showing that there's been an increase in rents of 5.5% in the multifamily space. It's not true today, so it's a lagging indicator. Call it 9 to 12 months ago. The other component of that 0.25% of CPI is the single family space, right? So there's 16% of that CPI data that's reported is the Bureau of Labor Statistics interviewing homeowners and saying, what would you rent out your house for if you were to rent it today? So it's pure speculation and it's a survey. It's not 85,000, different data points like the rest of the CPI data that's recorded. It's a short survey that's done on a monthly basis with owners that are asked about a hypothetical rent for their house. That to me, it doesn't seem like an accurate depiction of reality. So some of the data I think is skewed, some of it's lagging, and that's some of the reason why you're seeing those numbers be, higher. At the end of the day, I think most people expected a rate decrease at least 3 times this year, and with the first one being in June. I think as of yesterday, most people felt that way still. If you ask people today, and I've been talking to our traders here, the probability of a decrease in rates come June is now less than 25%. Right? It was 75% last night. Now it's hovering around 15%. So, higher for longer, I think probably at least until the end of the year. And then, where does it normalize? Time will tell.
Chris, such a great answer. I mean, there was at one point, if you remember, I think it was either December, January, there was anticipation of possibly 6 rate cuts, which is never going to happen now. And I love the fact that you're bringing up this laggard data that we're utilizing to make really big decisions that are impacting trillions and trillions of dollars. Like when you talk about, hey, it's just a survey. Hey, Chris, where are you going to lease your house? It's shocking to me that we have AI and all this other, data that we could put into a system and spit it out fairly quickly. Yet we're using this kind of data for the Fed to make decisions around interest rates that impact so many people's lives. It's hard for me to comprehend, even when you look at the current unemployment numbers, right? They come out, oh man, gosh, unemployment's down. But then you start to dig into it. A lot of it's government jobs. A lot of it's people with, part-time jobs. I just want to get, you've been in this business for 12 years, your assessment on the data that we're using and impacting so many people's lives, such major decisions. It just doesn't seem to be congruent.
Yeah, it doesn't. And I would say, that lack of congruency is really going to have an impact on landlords, principals, people that own real estate, not so much maybe the single family space. Like I think I saw a stat a couple of days ago that 80% of residential mortgages are 4% or under, which is healthy debt. I'm talking more so the commercial guys, right? The self-storage, the multifamily, the office, the hospitality, in a higher rate environment, higher treasury, higher Fed funding rate, whatever we want to call it. At the end of the day, it's a higher interest rate. That puts downward pressure on values. It puts downward pressure on, people's portfolios and their ability to exit at a floating rate debt or their ability to execute on a business plan. So, it's, some of it's kind of putting an artificial downward pressure on values across the market. I don't know that I have the answer for what's a better indicator, but there it seems like it's we're going to be in this higher rate environment for a while.
Well, you bring up a really good point, but if you look, are you familiar with Trueflation? Have you heard of that?
Yes. Yeah.
So Trueflation's had us at 1.6, 1.8. I didn't see what it was today, but it's definitely been below that 2% mark. And this is for another time when we have another podcast together. But when people really understand where that 2% benchmark comes from, it's fairly arbitrary. And again, we're making these major decisions based off a somewhat arbitrary or try to hit a somewhat arbitrary number. It's just stunning as you dive into the details and the power. I mean, Jerome Powell, when he speaks, a lot of people listen and impacts a lot of people's lives. So with all that being said, you mentioned, hey, a lot of multifamily are seeing rents either stagnant, possibly even going down. We don't see it as much maybe in storage as far as the refi piece, but we are, as a team, definitely waiting to hear from some people going, it's time for me to refi. The rates are higher than I expected. I just can't make this work. Are you starting to hear some of that throughout different asset classes? And if so, where?
Yeah, we definitely are. I mean, I'd say that I've been seeing that for maybe the past, 12 to 14 months, Chris. And that just goes to the creativity comment that we talked about earlier, right? We have a client that we've been talking to. We sold them an asset. So Walker and Dunlop, our investment sales team, sold them an asset 3 years ago. It was a value add opportunity. And it came in, they renovated. Their whole strategy was to exit 2 or 3 years later. Here we are 3 years later. And the cost of capital is much higher than what they had modeled in their exit analysis. So, we're having to get creative to help them in that, kind of maturity analysis or exit analysis. And that's done in a variety of ways. I talked about, creative financing, right? I talked about pari passu funding structures. There's also, pref equity. There's also mezzanine financing that can get you up higher up a capital stack. The downside to all that is that it's higher cost capital, right? So you have to know that you have to be eyes wide open going in. The pref equity today is pricing, call it anywhere from 12 to 18%, just depending on the opportunity, depending on the market, depending on the asset class, principal. And that's a decent yield for an investor, right? But from the principal standpoint, you have to know you're giving up a lot of your profit on the back end to make the deal work today, right? So, it's not, pref isn't necessarily for every client, like mezz isn't necessarily for every client. A lot of the advice that we're given to folks today is, position yourself for success, right? There's going to be dips, there's going to be ups and downs in the market. We had a loan that we closed at the end of last year where this client, it's multifamily deals, a deal in Dallas, very strong asset, very strong principal. And we were just watching the market, towards November, December. And I don't know if you remember, there was call it a 40 or 50 basis point decrease in the treasury, at least in the 5-year treasury in November, December. Fortunately, that worked out for them, right? Like, because it could have gone the other way. And we were watching it. And, when treasuries dropped 10 bips, you better believe we were on the phone saying, hey, should we rate lock this now? And we're like, oh, let's hang tight. We're trying to do a cash neutral refinance. So, right, we're trying to minimize a cash in for this client. We kept watching. Treasury dropped 20 basis points. We pulled the trigger. I think Treasury dropped 22 bips in like 10 days. We rate locked a cash neutral deal. And I think he got a good loan. Now, unfortunately, for the next 2 or 3 weeks, the Treasury continued to drop, right? So he could have got a better loan if he would have waited, but we didn't know that at the time. So we locked at a time that made sense for him, and got him out of what was a tough situation, right? He was going to cash in $500,000, prior to that decrease, which
Wow.
may not sound like a ton of money to some people, but it's real money, So
Very well said. You hear a lot of conversations about the regional banks because they've got maybe office space on their books. They're concerned about that. If you want to speak to that, that'd be great. I know your focus is really multifamily. So if you want to speak to what you think is going to happen in a regional, do you want to speak to that, the regional banking situation?
yeah, I mean, I'll talk to what I know from a banking and from an office standpoint. And again, multifamily is my space, but where that really enters my realm is repurposing or readapting some of that office space to be multifamily use. And this is something we've been hearing about for the past 2 years. Unfortunately, we haven't seen too much of it. And I think when you get down to the nuts and bolts of it, it's very hard to repurpose an office space to multifamily if you're 30, 40, 50% occupied, right? It's from an occupancy standpoint, operating office, that's a bad occupancy number. But how do you get those tenants out? How do you get those commercial tenants out to completely vacate to repurpose as multifamily? It takes time, right? You have the buyout leases. Some people don't want to be bought out, so it's been a slower process than I think most people expected, but it makes sense once you actually start getting into the heart of those opportunities. So, again, multifamily is my space, so I don't want to predict what's going to happen in the office space, but how it impacts us is really the readaptive use to it to residential.
Quickly, because I do want to move on to multifamily. Do you think some regional banks are doing sort of the extend and pretend situation with many clients to try to help their books right now, or is there going to be a point maybe in the next couple of years where it just, hey, this house of card crumbles and we're all kind of standing around looking at each other? Or what do you anticipate in the next 24 to 36 months?
I think there's definitely a looming maturity, of office debt, coming this year, next year, the following year. From the lenders that I've talked to and the lenders that have, office on their books, they are trying to work with principals to help extend and try to get into a different rate environment to avoid losses, both for existing relationships that they have, but also for them. So, but that might not be every lender, but some of the lenders that I've talked to, they are taking that channel or that route with some of the office paper that they have on their books.
It seems, and you're in the numbers deeper than I am, but it seems that we are definitely inching towards a potential cliff. I don't know when that's going to happen, if that's going to happen, and yet you get that sense as you talk to more and more people. So let's talk multifamily. There has been a lot of supply that has come on or is coming on, I believe, within the next 12 to 18 months. And I've heard in some markets such as Dallas, where you go into Dallas right now and everyone was moving to Texas from California, and there was a lot of in migration, a lot of multifamily went up, and now I've heard 3 to 6 months free rent when you sign on because they're just having that much supply, that much vacancy. So if you can speak to Dallas specifically, great. Or what are some other markets where you're seeing maybe not the returns the investors expected? Let's put it that way.
Yeah. No, I would say Dallas is a great example there, Chris. I have a lot of clients in Dallas, and I've worked on a lot of multifamily deals in Dallas. And you're right, there is call it an oversupply issue there that is creating concessions in those markets. Look, fortunately, 3 to 6 months is not the end of the world, right? If that's all you need to provide to stabilize and get your occupancy up, and then know that in 6 months, once you get through your leasing, that you're at a stable NOI, it shouldn't be as bad. But those concessions definitely do exist, and like in markets like here in LA, we're seeing rents remain flat here as well. Not all deals, but a lot of properties, older vintage stuff that's subject to rent stabilization or rent control, that stuff will gradually have an uptick in rent, and that's a consequence of just, rent control or rent stabilization in Los Angeles, with just having, max rent increases that you can do annually. So there's always going to be a slight bump just because you're so far under market. But on newer construction stuff in SoCal, we're seeing, those rents remain flat.
So I know that you have got somewhat of a portfolio in affordable housing. It's a focus of yours. We can go big picture, small picture here, but I really like you. You're born and raised in California. there is this huge housing problem in California. There's some mandates coming down from the state that I think a lot of municipalities don't necessarily agree with, but their hands being forced. If you were king for a day, how would you solve this housing problem in California?
It's a big question.
It's an easy one, right?
Yeah,
we got 30 seconds.
Yeah, that they were all softballs before that one. Look, I think that some of the stuff, like at least here in Los Angeles, some of the stuff that our new mayor, Karen Bass, is trying to do around low-income housing and moderate-income housing, I think is gonna help. To what extent it helps, right? Like, time will tell. I'm definitely seeing a lot of different opportunities here in LA that are Executive Directive 1, ED1, is kind of the short for it. And that was Mayor Karen Bass's kind of like highest priority coming into the mayor seat last year. And that essentially is, streamlined processing of multifamily developments in Los Angeles. If you agree to set aside, your units at specific income levels. So it's 80% of your units at 80% AMI, and then 20% of your units at 110 to 120% of AMI. So low income to moderate income, or you may call it, affordable or workforce or blue collar housing. So if you do that, the process is quicker than it would typically be. So if it takes you 18 months to entitle a development deal in Los Angeles, traditionally, that process is supposed to be much shorter. The target is 30 days or 60 days.
Wow.
I haven't heard of anybody that's doing it that quickly. And I have a client that's building a lot of it, or RTIing, ready to issue permits, a lot of it. And they're saying it's taken, 6 to 8 months. So it's, much longer than the target of 60 days, but much shorter also than 18 months to do traditional multifamily. So, I think that'll help. I think that'll help increase housing supply in Los Angeles specifically. That RTI process taking 6 to 8 months versus 18 months helps reduce your carrying cost, right? So at the end of the day, your margin is a little bit better, and then it's going to be a lot of 80% set aside and 120% set aside multifamily throughout Los Angeles. So we're seeing a lot of it, and another benefit of that is just the building density that you get. I think prior to ED1, if you had, call it a 7,000 square foot lot, you maybe build, 6 units on that, maybe. With ED1, I'm seeing clients that are proposing 35 to 50 unit developments because of this Executive Directive 1. And this is all, again, affordable or moderate income, but much denser development than what was previously possible.
So walk me through ED1. I'm not familiar with that. So how does the ED1 allow someone to go from 7 to 35?
So there's benefits that you get to being able to build out or build up on a site that you wouldn't otherwise be allowed by traditional zoning. And it's a perk that's given to you if you agree to create affordable housing.
It's good to hear that in a way. I mean, I don't know how that's going to play out in LA, but the more you just get around LA, you have to ask yourself, when are we going to finally start to build up? I mean, you spend some time in Manhattan, you're like, okay, they got the building up process down. When does that happen in LA to start to, and I shouldn't even use Manhattan as a good analogy because we all know the price of housing there as well is, exorbitant. So it's not an easy problem to get solved. One, because like you talked about, just the time it takes, and I don't want to speak for all municipalities, but sometimes maybe they're not as loving to developers or developments as developers or developments would like to see them be, plus just the cost in themselves of construction. So there's a lot of moving parts that it's not an easy solution. What say you?
Yeah, no, I agree with you. I mean, look, that comparison of New York to LA, I'll say that I lived in New York for a couple of years. I moved back to Los Angeles in 2014. And my first thought when I moved back and I'm landing at LAX and we're flying over El Segundo was how green it was and how many trees there were, and how many mountains there were. And the next thought I had was like, I wonder what Los Angeles will look like 50 years from now, because there's a lot of room to build up, and I'm not trying to upset the environmentally friendly folks and tear down all our trees and rip out all our mountains. But, I think there is a lot of potential in Los Angeles still to continue building. And look, I honestly do think that ED1 is going to help out with a lot of that affordable housing. Does it solve it? No, but does it help? Yes.
Yeah, I mean, even right now, if you just look at what's going on in Miami, right? I mean, Miami is such a unique place where they do build up, and yet you're right on the water. I don't see that happening in California, but there are plenty of opportunities within downtown LA or other areas to start, building up and hopefully find a solution to really, really serious problem. A lot of people getting pushed out of the state because of the cost of living. So, Chris, it's been great. I want to be respectful of your time. Anything else you want to add, share, discuss that I haven't asked you about?
Look, no, I appreciate you having me on, Chris, and look forward to the next opportunity. A lot of good questions, so thank you for having me.
I do want to wrap up with one last question because you and I met actually at church, and just curious how has your faith impacted your role within commercial real estate?
That's a good question. I think definitely positively. I would say that my faith, I think, has me driven a little bit more by my heart than maybe the traditional banker. So if there's an opportunity for a client, let's say, that is maybe not the typical institutional profile that we would see, there's a heart to help those people and inform them and educate them and expose them to decision makers, right? That maybe they wouldn't have available otherwise. So I think it's definitely played in. I mean, I've taken clients to Fannie and Freddie's office in DC, McLean, gotten them exposure to decision makers at both agencies, and that stuff goes a long way. When you can sit across the table from a head of sales for a federal agency, quasi federal agency, I guess, it helps in building a relationship. It helps in getting things done. So that's how I would say. That's my short answer.
I love it. So for people out there that want to get a chance to meet the 2024 Rainmaker of the Year and Visionary and Real Estate Finance of the Year, according to LA Times, how do they get a hold of you?
You can email me, cmontes, CMONTES, at walkerdunlop.com. You could also, reach out to me, and you can, I don't know if I should put my cell phone number on here, but let's keep it with an email.
Yeah,
let's keep it with an email.
Socials, are you on like LinkedIn, things like that?
Oh yeah, I'm on LinkedIn as well. So you could find me if you just keyword search Christopher Montes. You'll see this beautiful face pop up.
Nice. See Montes at walkerdunlop.com. Again, if you've got any questions about finance, you want to just get some help, try to put the deal together. Obviously, Chris has won some awards and get creative and help you do that. So thank you so much for joining us here on the Commercial Real Estate Report, empowering you to build generational wealth with real estate.